Hi, everybody. I'm Lorna Hennington, and this is Tracy Bates. And we're here with the next installment of the Bates Hennington Team YouTube channel video. Today, Tracy's going to share her screen with us so we can go through some slides. We get a lot of questions asking for forecasts for the rest of the year. And although we don't have a crystal ball, ooh, I wish we did. Ooh, we'd be just
We'd be like super rich if we
oh
did.
my gosh, ooh, big money.
And our clients would be super happy.
Even though we don't have that little piece of equipment, we do have a lot of indicators that give us an idea of how things are going to look for the rest of the year.
Right.
Now, this is
So
based
true.
on numbers from June. And so just know that things could change a little bit if things change with coronavirus or other factors like the election, what have you. Our forecasts could shift, but this is where we are right now.
Right. And so right now, when we looked at before this forecast happening, we work in concert with Keeping Current Matters, which is a resource for real estate agents and people in the real estate community to keep us updated on what's happening nationwide. And they get their resources from different reputable Wall Street Journal, Forbes, all these different outlets contribute to providing information and helping with the forecast. So the consensus was for a little over 3 million jobs to be added in June. And almost 5 million were added. So that was a shock in that there were many more jobs, added than was anticipated.
Which is a really great thing. And also the trend that we're seeing is that the unemployment rate is headed down. You can see that it really jumped up in April as a result of the pandemic, but over the last 2 months has dropped a percentage point in May and 2 in June. And right now we anticipate that trend to continue.
Right. And this is from the Wall Street Journal that says U.S. job growth surged last month, underscoring the economy's capacity for a quick rebound if businesses continue to reopen and consumers regain confidence. A recent coronavirus spike, however, could undermine trends captured in the latest jobs report. And we have seen a spike in some areas or some states, including California, unfortunately, where we are. So we'll continue to monitor this and see what it looks like. But there was a job growth surge in June.
So one other piece of good news is that unlike several years ago when we had a real collapse in the real estate market
in 2008,
right now a lot of people are opting to get a forbearance on their mortgage, which means they've made an arrangement with the mortgage company to postpone some payments on their mortgage. But what's really good and different than 2008 is that at least 77% of the people who are past due on their mortgage payments have at least 20% equity in their home. Unlike in 2008, where we saw a lot of people who owed more than their home was worth. So it's a much better picture currently than then.
Yeah, our home market is much stronger than it was, and that collapse in 2008 was a real estate driven economic crash, whereas this one isn't. The high level of equity provides homeowners, policymakers, mortgage investors, and servicers in helping to avoid downstream foreclosure activity and default related losses, meaning that when you're looking at 77% of homeowners who have over 20% or at least 20% equity in their homes, they're not necessarily looking at a foreclosure situation. They do have the option of selling, which is a good thing, and in selling in a market where they can pull their equity and not have to be concerned about a short sale.
Exactly, and they can use that money to do other things. Little bit of scary thought is that 87% of home sellers are concerned that their home won't sell because of the pandemic and the resulting economic recession. And that's not quite accurate, even though that's what a lot of people are feeling now. We are seeing incredible amounts of activity in the real estate market. And for example, this little nugget, 372,000 homes sold last month in the US. So there is activity. So the concern that you cannot sell your home during this market is not quite founded in fact.
Yeah, not quite. And we just came out of a multiple offer situation on two of the deals that we were in. So we're seeing in our market in Los Angeles, in certain pockets of Los Angeles, in desirable homes, multiple offers happening. So as we navigate through this COVID-19 situation, home has taken on a different meaning for a lot of us. And home ownership remains one of the main tenets of the American dream. Everyone
Yeah,
loves
our
one
homes
home
are so much more than just shelter now. They're
now. Right,
so the site of our businesses and childcare and elder care and everything else.
you're right.
So we had a dip in March, real significant, not going to lie, on property showings in North America, including the US, and I'm assuming that also means Canada. But then beginning in May, a very sharp increase in the number of showings of properties.
It's amazing if you look at what happened in January, where we were in January, and then right before the pandemic, February, you know, we're way above that now.
Yeah.
And February was, a regular market before coronavirus hit. So we're above where we were with showings.
Mm-hmm.
The year-over-year change in buyer viewing appointments, virtual appointments and in-person appointments combined nationally is a positive. It's over 21.4%. So that's huge for us.
Yeah.
In the West particularly, it's up 19.6%. So
Over
that's
last
amazing.
year. Yeah.
Yeah, that's amazing.
Okay. So housing market recovery. So right now, you can see where we were. Probably that is about
That
February.
is February.
Yeah, and then we had a big drop, and then now we're on the rise, up about 95.8% of where we were in February and headed upwards.
Amazing. Who would have thought? We would have never have guessed this.
When
So
we were all shutting down in February and thinking everything was going to collapse, this is not what's happening.
yeah. New pending sales is up 18.8%. New listings is up 5.2%. Total listings is down 20.7. New listings down 16.6.
So in the months, we are definitely increasing. If you look at it year over year, we're still down a little, but it's going up every month.
It's going
Both
up.
sales and new listings.
Right. And again, another year-over-year change in listings.
Yeah, exactly. So you can see where new listings really dropped, and total listings really dropped in March, and they're both on the increase. Actually, we've got a little bit of leveling off on total listings. New listings is increasing a little bit. And the reason things are just kind of leveling off over that total number is that for quite a while we were low on new listings, but those are starting to increase. Right now, though, pretty much inventory is a lot lower than it would normally be, which puts sellers in a strong position right now.
Right. Inventory as a percent of households is half of the long run average. So the long-term average 2.4%. Currently, we're at an all-time low of 1.2%.
And home prices, they're continuing to appreciate. You can see the appreciation between 2020 and 2021. It's up, and it is expected to increase continuing into 2022.
I mean, that's amazing. The home prices are expected to increase over 2.8 or up 2.88% from 2020. So we're not looking at a downturn.
Yeah, and this is not just one source indicating that. There were several sources that all were.
I can go back if you want.
Oh, no, it's okay. Thank you.
All right.
It's pretty though.
The severity of inventory tightness should remain a relative benefit to home prices, but it is also a risk factor to the degree of rebound in unit sales going forward. So we don't have a whole lot of inventory, which means that prices can remain strong because the sellers can still command what they want. But in terms of the number of units or homes that are going to sell and have sold, it will be an overall lesser amount if this trend keeps.
The housing market is likely benefiting from low mortgage rates. I mean, we're at 60-year lows. We have Movement Mortgage and the lenders we work with over there closing things at under 3%. So the housing market is likely benefiting from low mortgage rates, stronger demand for larger spaces as more and more people work from home, and a desire to move away from crowded cities to avoid exposure to the coronavirus. Now, that's a new trend. People who just want to get out of big cities like New York and Los Angeles and move to more suburban and urban and rural areas. And we've got a slide coming up on that.
Right. This slide says nearly 30% of respondents living in a high density urban area say that the pandemic is prompting them to want to move by the end of the year. This is more than double the rate of those living in rural parts of the country, where residents are much more likely to stay put rather than to relocate. So again, reinforcing that the move looks like it's more out of the city than coming into the city.
Yeah, into less dense areas. And this is the slide that really increases, it shows this increased desire to get out of the city. Buyers showing a greater desire for non-urban properties. It's up 16% in rural areas. People who want to have a farm and chickens, and like Michelle Obama said, a garden with vegetables. People who are just want to be in more suburban areas out of the most dense areas. And that's up 13%, and 7% is up in urban areas.
Right.
Desire for these properties.
Much like the suburbs are gaining favor with home shoppers, second home markets are seeing increased interest from luxury buyers. In New York, Suffolk County, home to the Hamptons, in Palm Springs and Riverside County, and in Greenwich and Fairfield County, Connecticut, all second home markets ranked among the top 5 markets with the largest increase in listing view growth in May. Views of luxury properties accelerated 56% in the Hamptons, 28% in Palm Springs, and 24% in Greenwich compared to January trends. I want a home in Palm Springs.
Me too. I want somewhere to run away to. Right?
Yeah, that'd be fun.
Yeah. Since the pandemic altered what buyers value in their homes, builders are predicting how future homes will change as a result and what people will want moving forward. I found this really, really interesting.
Yeah.
People, since they're working at home a lot, the open concept floor plan that we've all gotten very familiar with, builders are expecting that to change and people to want more separate spaces with more walls for more privacy, because you're now working from home. You may have parents who are living with you and they need a living space as well as a sleeping space. And so more walls are expected. I think that's really interesting. And just another thing, new construction, which offers the chance to personalize your home features, saw listing page views grow by 73%. So people really wanting to tailor the living spaces they're in to meet this multi-functionality kind of lifestyle.
Yeah, it'll be interesting to see how that affects the Los Angeles market. We don't have a lot of new construction happening. But maybe it will.
Yeah.
Maybe it will in the suburbs. We're going to talk about interest rates a little bit because that's really interesting and a hot topic right now.
I mean, could it drop anymore?
I don't, we have it here, it looked like in February, we were like at about 3.95%, which was a great interest rate if you could get that, it was
Fantastic.
Under 4%. Yeah, and at the beginning of June, it went to 3.13%, which is incredible. And like you said before, we've seen 2.99% with one of our lenders, Movement Mortgage. So, I mean, to get an interest rate, a mortgage rate this low, it's a life-changing situation for a lot of people.
And that's why a lot of people are refinancing right now.
Yeah,
a lot of spending a lot of time not on loans for purchases, but refinances. Because people, I'm at 8%. Let me get out of that mess.
Who's at 8%? Oh my gosh.
I know.
Okay, we need to get out of that. Hurry.
I think my
God
parents
will
were like
help
at
you.
12%. Okay, I'm at like 5%. Let me get
Okay, all right.
So mortgage rate projections. We are expecting them to just keep dropping.
Yeah, that's
quarter 2020. Listen, we've already surpassed this or gone below this 3.22.
right.
Quarter 2020, 3.17. First quarter 2021, 3.12, and the second quarter, we're below that already. But how much further it can drop is a question. So it's a great time to buy if you can do it.
Great time to buy, great time to refinance too. This is just another slide that shows the actual and the projected. So you can see here in 2020 where we are. In 2021, it drops even more significantly. Again, a reflection of what the last slide showed.
Crazy.
And
here
again, we're really into this interest rate thing. We want to let you know for sure
they're going down.
that the interest rates are going down. Yeah. This is a good one. Average days to close a loan. This is important. Go for it, Lorna.
Well, we were seeing and we were telling clients in kind of the middle of 2019 that it was about 30 days to close a loan. Then it started to go up a little, peak a little bit. And then it started to drop in the beginning of the year before Corona. And then it was really dropped because there just weren't a lot of loans being processed. And now it's starting to tick up a little bit, again, related in part to the refinancing of loans. So it's taking your lender a little bit longer to get through files on their desks. And this is just a function of that. So now what we're telling clients when we write them offers is, put in 45 days. We speak with the lender. Sometimes they say they can do better, but it's better to be safe than sorry and not get yourself into a pickle with your contingency on the loan and a tight timeline. So about 45 days in May is what we were seeing and what we're seeing right now.
Right. And FICO score requirements over the last 12 months. So that's changed a little bit. You can see in June of last year, we were at a 731 average FICO score requirement for a mortgage loan. Now we're at 750. So the guidelines have tightened up a little bit. I'm not sure what that is all owed to. Some of it could be owed to the multi-unit purchases in mortgage loans. I'm not sure. I know more multi-unit properties had tightened up their lending restrictions. So that might be in part due to that, but it looks like the average is about 750.
And jumbo loans for single family.
Jumbo loans for sure. That's right.
So that's,
yeah.
And look at this. What is that number under that little scroll, Tracy? What's that percentage? Can you see?
Which one here?
That orange? Yeah.
700 to 749?
No, the 500 to 749, because my math is bad. So that's 7.
Oh, 500 to 749. 249?
I'm thinking it's about 50. About 50.
Oh, 50%. Yes.
50% of people are below 749, their FICO scores. I always find that interesting because I always like to think about where I am. I'm not going to point to where. But how do I compare it to the masses? But about 50% of people who know their FICO scores or have pulled them recently are below 750. So if you're in the above 750 number, you are a star. You are in the top half. And if you are above 800, well, call me. Call Tracy.
And this is for all loans, the average FICO score is 750. Conventional is 755. If you're looking at an FHA loan, the average is FICO score is 682, and VA loan is 716. So this just gives you an idea if you're a buyer where you should be looking in terms of FICO scores. And if you don't think that you're there, you can talk to the lender and find out what you need to do to get there. You can also, there are also services like Credit Karma and some other ones that'll run your credit score for free and let you know what delinquencies are showing up or where you're having an issue that you can try and correct. So
yes. And please forgive the background noise. My fabulous gardener has to.
I don't hear it. And that's the last slide.
Is that it?
Yeah, that's it.
Yeah, I hope that really helped you guys to get some insight into where we're going. both in terms of lending and also in terms of what kind of volume of business is going on in real estate and how much inventory is going to be on the market. And we'll keep you informed as we move forward through this year. And you can always call us if you want to get an idea of what's going on in your particular market. We're here for you whenever you need at experts@bateshennington.com. You can email us there. That is probably the best way to get in touch with us, huh, Trace?
Yep, sounds good. Experts, and you can always go to our website, www.bateshennington.com. There, all our information is there, and you can shoot us a message too. So thanks so much for tuning in, and we'll see you next time.
Have a great weekend.
Bye.